It started as America's fastest real estate boom. Miami's home prices jumped 35% in 2 years, with nearly half of all deals paid in cash. But when Florida's housing market exploded, leaving families priced out and lenders in chaos, the blame fell squarely on Governor Ron DeSantis. Now, the governor is being fired as the American system teeters, and cities across the nation may be next. How did the dream turn into disaster?
Florida's population boom rewrote the rules overnight. Between 2020 and 2022, more than 600,000 people moved into the state, drawn by the promise of sun, freedom, and remote work. Miami led the charge, welcoming a wave of newcomers who brought cash, lots of it. By mid-2025, 43% of home sales in Miami were all cash, a figure unmatched anywhere else in the country. The typical home price in the city soared, climbing 35% in just 2 years and pushing the median price to $560,000. For many local families, the dream of homeownership slipped further out of reach as out-of-state buyers and investors snapped up properties, often above asking price and with no financing required. This surge wasn't just about numbers on a spreadsheet. Entire neighborhoods changed hands in months. Bidding wars erupted over modest condos and starter homes. The price-to-income ratio in Miami ballooned to historic highs, with UBS naming it the world's riskiest housing bubble in 2024. Local incomes couldn't keep pace, and the gap between what people earned and what homes cost grew wider by the week. Speculation flourished as investors, both domestic and international, treated Florida real estate as a quick bet rather than a place to live. The flood of capital pushed the market well beyond what most residents could afford, setting the stage for a correction that would hit hardest at the heart of the community. Cash dominance and relentless demand fueled a runaway market, but beneath the surface, the system was stretched to the breaking point. The American promise of homeownership in Florida had been hijacked by a tidal wave of outside money and unchecked speculation, and the consequences were about to become impossible to ignore. UBS didn't mince words when it named Miami the world's riskiest housing bubble in 2024. The price-to-income gap had reached a point where even professionals, teachers, nurses, city workers, were locked out. One Miami-Dade teacher described watching her rent jump by $900 in a single year, then learning she would need a $150,000 down payment just to compete with cash offers. For families like hers, the market wasn't just hot, it was hostile. While financial analysts raised alarms about unsustainable prices, the governor became a symbol of the boom. Ron DeSantis, quick to champion Florida's economic surge, appeared at ribbon cuttings and in press conferences touting the influx of new residents and investment. His administration leaned hard on the narrative of prosperity, but ignored the growing warnings from economists and housing advocates. The state's leadership seemed determined to ride the wave, even as affordability vanished for ordinary Floridians. Behind closed doors, watchdogs and local leaders questioned why the governor's office failed to act. The lack of intervention on runaway prices, unchecked speculation, and mounting insurance burdens fueled frustration. Critics pointed to campaign donations from real estate and insurance interests, arguing that policy favored outside investors over the people who actually lived and worked in these communities. As the bubble swelled, the governor's public image became inseparable from the crisis, and calls for accountability grew louder. For many, the face of Florida's housing disaster wasn't just a statistic, it was the man in charge.
Insurance companies began abandoning Florida at a pace no one had seen before. By mid-2024, 54 carriers had either pulled out or stopped writing new homeowner policies statewide. Letters arrived with little warning, non-renewal notices, policy cancellations, and premium hikes that left families scrambling. For many, the numbers were impossible. Premiums that once averaged $2,400 a year now routinely topped $9,000, sometimes quadrupling in a single renewal cycle. In Miami-Dade and Monroe counties, annual bills of $12,000 or more became common, especially for older homes and properties near the coast. With private insurers fleeing, Citizens Property Insurance, the state's so-called insurer of last resort, ballooned to cover more than 1.35 million policies. That's triple its count from just a few years earlier, and far beyond what experts consider safe. Risk became dangerously concentrated. One analyst described the situation as a game of musical chairs. Only this time, the music had stopped and most Floridians were left standing. The fallout hit households directly. Mortgage approvals fell through as buyers couldn't secure affordable coverage. Escrow requirements spiked, sometimes adding $10,000 or more to closing costs. Families who had stretched to buy a home were blindsided by renewal letters demanding thousands more, forcing some to sell, others to risk going uninsured, and still others into foreclosure. No other state saw such a rapid, widespread insurance meltdown. The American system that promised security through homeownership now delivered uncertainty and fear with no clear end in sight.
Hurricane Ian left a $65 billion scar on Florida's insurance industry, but the real damage kept spreading long after the floodwaters receded. Global reinsurers, burned by repeated disasters, hiked their prices by as much as 50% in 2023. For Florida's remaining insurers, that meant sending half or more of every premium dollar straight to overseas risk pools, far above the national average. The math no longer worked. Companies passed costs to homeowners, who faced annual bills of $8,000, $12,000, or even higher. In Miami-Dade, it wasn't unusual for a family to pay more for insurance than for their mortgage. Legal costs piled on top of catastrophe losses. At one point, Florida accounted for nearly a third of all property insurance lawsuits in the country, driven by a wave of contractor claims and attorney fees under the assignment of benefits system. Even after state reforms tried to tamp down abuses, the legacy of litigation lingered, draining reserves and pushing more carriers to the brink. Escrow requirements ballooned as lenders demanded proof of coverage up front. Some buyers saw their closing costs jump by $12,000 overnight, making even well-qualified borrowers back out. Mortgage rates, already above 6%, left little room for error. The combination of surging premiums, legal drag, and higher borrowing costs froze the market. Transactions stalled, appraisals fell short, and sellers were forced to slash prices or pull listings entirely. The backbone of Florida's housing market, everyday buyers, could no longer carry the weight. What started as a storm became a financial undertow, pulling the entire system further from shore.
Homeowners across Miami-Dade opened their mailboxes to find notices they never expected. Property values had fallen, but their bills kept climbing. In just 12 months, average home prices in the region dropped by 12%. Condos fared even worse, with some buildings seeing values plunge 17% or more, especially those facing steep new safety assessments after state reforms. For many, the math stopped working. Families who had stretched to buy at the peak watched their equity vanish almost overnight, leaving them underwater on mortgages that no longer made sense to pay. Foreclosure filings, once rare in these neighborhoods, began to double in key zip codes. Owners unable to afford ballooning insurance premiums or surprise special assessments, sometimes tens of thousands of dollars per unit, were forced to sell at a loss or walk away entirely. Stories of retirees cashing out savings to cover $30,000 or $40,000 in urgent repairs became common. The ripple effects touched every block. Abandoned units, empty playgrounds, and families uprooted with nowhere affordable to go. Behind every statistic was a household losing not just money, but security and hope.
On August 19, 2025, Florida's political crisis reached its breaking point. After months of mounting outrage, a petition with over 1 million signatures landed on the steps of the state capitol, demanding the removal of Governor Ron DeSantis. The legislature, facing public fury and a collapsing market, called an emergency session. By the end of the week, lawmakers voted to certify the recall, making DeSantis the first governor in Florida history to be forced from office over economic mismanagement. National regulators wasted no time. The FDIC and HUD issued simultaneous warnings, naming Florida as the epicenter of a new Sunbelt contagion, a threat that could ripple through Texas, Arizona, and the Carolinas if unchecked. The message was blunt. What happened in Miami was not just a local disaster. It was a symptom of a broken American system, where unchecked speculation and failed oversight let entire states spiral into crisis. DeSantis's downfall became a cautionary tale, a warning shot for every governor in the country. No city, no state was immune.
In 2024, Miami was labeled the world's most overvalued housing market by UBS, with Florida home prices jumping 35% statewide during the pandemic. As the market turned, 54 insurance companies exited the state. Premiums in some coastal counties rose by 400%, and more than 1.35 million policies shifted to the state-backed Citizens insurer. By mid-2025, Florida saw a 12% statewide price drop and a 17% fall in condo values, with thousands facing special assessments as high as $50,000. Despite widespread anger and a recall movement, no official records confirm the removal of Governor Ron DeSantis. Key questions remain about how systemic failures in insurance, regulation, and lending will be addressed, and whether other American Sunbelt markets face similar risks. What is clear? Florida's crisis exposed deep flaws in the American housing system, and the fallout continues to shape families and entire communities across the state.